and we'll be right back. Thanks. Hello, good morning, welcome back, and welcome to day one at TiEcon Delhi's Unstoppable India. I'm excited to be here. My name is Kanika Mathur, and I'm your host for this session. This session is co powered by IIFL and AMSS. I'd also like to thank Sequoia Capital, our platinum sponsors, for their continued support and being part of this event. Thank you so much. Before we kick off, I'd like to make a couple of announcements and just for you all to look at what's going to be happening. One, of course, do remember to share your experience with us and tweet at the rate Thai Delhi with hashtag TiEcon Delhi 2022 and hashtag Unstoppable India. I look forward to seeing you on whatever platform you like. Please also keep checking the broadcast messages for more details on offers and parallel sessions. You'll see it coming on the top also. Do spare some time to engage with our partners at the virtual exhibition. You can click exhibition on the top navigation and go there. And you could go to the exhibition booths. And for people who are interested, you can also attend uncovering secrets of successful startups, pivot and persist. This is scheduled to commence at 11:15 at the Infinity Hall. Lastly, I'd like to talk a little bit about, it's raining coins at TiEcon Delhi 2022. You can earn and collect these points as you engage on the event platform. The event platform has been specially built, to actually see what you all are doing on the platform. And you can redeem these points for a variety of networking and mentorship opportunities. So don't forget to interact and engage, and we look forward to your questions. And of course, I'd like to now talk a little bit about our panel and the topic. We have a really solid panel over here, and our topic today is uncovering the secrets of successful startup IPOs, and it's going to be a teardown. This session is co-powered by IIFL and AMSS. I'd like to now introduce the panel to you. We have Nipun Goel, who's the head of investment banking at IIFL Securities. Nipun has an overall experience of 26 years in investment banking. He was earlier head of investment banking at Nomura India, and prior to that, he spent 14 years with DSP Merrill Lynch in investment banking division. And he has extensive experience in capital market transactions. He's an MBA from IIM Ahmedabad. Prashant Gupta is a partner, national practice head, capital markets at Sardol and Amarchand Mangaldas. Prashant represents both issues and underwriters in various equity and debt capital raising transactions, including initial IPOs, rights issues, QIP offerings, buybacks, capital restructuring, and pre-IPO private placements. He's advised on capital market transactions that have raised over $50 billion globally, which include both the target IPO and bond offerings out of India, as well as the largest secondary trade on the stock exchange in India. Welcome, Prashant. Welcome, Nipun. We also have Samarth Jagnani, Head Global Capital Markets India, Morgan Stanley here. Welcome, Samarth. Samarth has been with Morgan Stanley for over 15 years and has been leading new product initiatives, including tech private placements, international listings, development of IT, REIT listings, alongside his responsibilities in capital market organizations and execution. And lastly, our chair, welcome Alok Bansal. He's the whole-time director and CFO at PB Fintech Limited. He's going to be our chair today. Alok heads various functions, including corporate finance and controllership, tax, treasury, strategic planning, and analytics. He firmly believes that primary responsibility of a CFO is to accomplish business goals rather than just concentrating on functional goals. Alok's core strength lies in strategic thinking, process control, and execution. He was recognized as one of the top 100 CFOs in the country by the CFO India magazine in 2016. Thank you so much, Nipun, Prashant, Samarth. And Alok, I'll hand over the chair to you now to take this forward. Over to you.
Hi, good morning, everyone. Welcome to the first day of the TiEcon NCR. We have a very interesting session lined up for you right now with a very stellar panelists. As Kanika would have introduced already, we have got Samarth from Morgan Stanley, Nipun from IIFL, and Prashant from Samco, which is Sadhu Ramachan Mangaldas law firm. We are going to talk about IPO today. And the way we want to do it is give you guys a little bit of idea around what is the process like, what does it take, what all you have to keep in mind, and what is the life post IPO. So we'll touch upon all these and encourage you to post your Q&As so that it can become more interactive and we can answer your queries directly. See, when we look at IPO as a process, uh, technically IPO is more like a culmination of a long journey in a company's life. It seems very complicated from outside, but it has these unique nuances which can be managed with the help of the right advisors. When we look at the IPO process, the core advisors are the bankers and the councils, and the whole process can be broken down into multiple parts, right from pre-IPO to the paperwork preparation to the marketing through, and the coordination with SEBI and exchanges at the last minute. So, we'll start off with some inputs from our panelists in terms of what do they think when a company should think of IPO and what is the pre-IPO preparation they should keep in mind as they're thinking about IPO. So, anyone can start. Prashant, you want to start here?
Sure, I can think look if you want. I thought maybe the bankers are probably better in terms of people really more interested in what they have to say. But sure, I can start. So I think in terms of the audience, this IPO could be 3, 5, 7 years away. I'm not sure where all of you are in your IPO journey. Some of you may not want to do an IPO at all, and want to sell out before. But obviously, Alok has been through it once, and he can tell you how much he enjoyed it. To be honest, I think Alok did the right thing. I think he engaged very early in the process with a number of advisors, which was probably 3, 4, 5 years ago. Alok, I don't actually remember the date, but I think maybe it was 2016 that when we maybe first spoke. And I think
Yeah.
over the years worked through several issues, which actually I think made the process much faster than perhaps other companies to kind of jump into it and then realize that they've kind of have 20 issues to deal with, which take up 1 year or 2 year of their time. So I'll sort of try to break down some of those issues so that you guys can start thinking about, you may not know exactly where you are in the IPO journey, but I think some of the important points to think of when you want to do an IPO and sort of what drives that process. I think generally, I think general hygiene is actually a very important aspect of running any company. Obviously, I think for most startups, given that they are so focused on running their businesses, that sometimes takes a back seat. And obviously, I think uh, I'm not saying start doing this the first day you set up a company, but I think it is important generally to start, having proper board minutes, a company secretary, etc., at least 5 years before you're actually going to do this, because there is no way to fix some of those issues later. And you're basically what ends up happening is that you have a lot of stuff that needs cleanup, which cannot be cleaned up, and ends up looking like ugly disclosure, where investors and regulators think there is no corporate governance in this company. So I think general corporate hygiene should be an issue people start thinking of relatively early in the process. I think that is the simplest part of doing an IPO. I think a few issues that we've sort of learned in the journey with companies such as Policy Bazaar, Paytm, and others in the last 1 year, delivery, pharmacy, etc. Kamal has also done others in Nippon as well. So I think one of the things that has become a huge sort of talking point is capital structure. I think one of the debates that obviously sort of sometimes comes up late in the discussion and takes up a whole lot of time is how to keep founders incentivized. And there is sort of an overlay of a promoter discussion there as well. So now, if you look at most of these companies that did an IPO, most of them did not have an identified promoter. So while Alok is actually a founder of Policy Bazaar, he was not the promoter. And that's a decision actually they took. One of the earliest things we discussed with Alok was that, I think, 4 or 5 years ago. And that opens up actually many avenues of keeping founders incentivized. Because if you're a promoter under the Companies Act, you can't get ESOPs. Now, what we've noticed in some other startups that we are working with is that that has not happened. And the way to keep founders incentivized, shareholders and investors have offered partly paid shares, where they end up paying sort of later in the process when an IPO is going to happen. The problem with partly paid up shares is that you actually have to make them fully paid before you file a draft document with SEBI. That generally has meant huge amounts of capital outlay by the founders, at a time when actually there may not be enough certainty for an IPO. So you effectively have to end up taking a loan, which generally will carry 15 to 20% interest because it's at that point unlisted securities, and obviously no one wants to do that. It actually becomes a relatively large roadblock in the IPO process. So I think one of the things that really helped Policybazaar, for instance, was the fact that they had taken this decision on who was going to be a promoter or no promoter, as most of them have had fairly early. They had decided sort of how to incentivize their founders longer term. So Yashish and Alok obviously have ESOPs. And ESOPs is honestly the best way from a SEBI perspective or even from a US perspective, to do that capital structuring. Partly paid up shares, and there are various other avenues people have used, doing selective bonuses, partly paid up shares, etc. Those come with huge issues. Sorry, Alok. So tell me if I'm taking too much time, but
No,
I'll
no, I
keep
think
going. But yeah, one point to just want to make figure out whether you want to be a promoter or not, or a founder, and sort of equity incentivization for founders. I would say at least 2-3 years before the IPO process. I think Alok is probably better positioned to kind of jump in here and sort of talk about that. Alok, if you want to spend 2 minutes, I'll just defer to you for a minute.
I think you've covered a lot of ground, Prashant, and it's very helpful for I think our audience to understand from the legal side and preparatory side what all it takes. Now I'll request Samath and Nipun to pitch in from the bank perspective in terms of when do they think a company should think of uh, IPO, and what exactly from the bank's perspective they would need a company to be ready with.
Well, sure. Maybe I could go next. Thanks, Alok, and delighted to be here. So, look, listing is an extremely important and a strategic event in the life cycle of a company. So, while it is indeed, and many people feel that it is probably the culmination of all the efforts that they have put in the run up to the IPO, the reality is it is just another milestone in the longer life cycle of the company. And in fact, I would dare say that actually life begins at IPO. And I think the kind of scrutiny and the kind of strategic benefits, that it confers, a successful listing confers, cannot be easily quantified. Actually, I am reminded of an example of about 22 years ago. So if you recall, in mid 90s, there were some of these large consumer durable companies, MNCs, which had kind of set up shop in India. So one of them, of course, I can't take the name for confidentiality reasons, set up shop in India in 1996. And this was the year 2000. They invited us to their global head office for evaluating listing of their India business. The company, the MNC, that particular corporate was amongst the top 10 corporates in the home country, and we were very very intrigued in terms of the India business was hardly $100 million. Consumer durable business does not have very high margins, so we were very intrigued in terms of why they would want to evaluate a listing when the parent, being so cash rich, could potentially pump in capital easily. And the CEO of the organization made a very interesting comment. He said, look, we are a consumer business, and no amount of paid advertising can mirror the profile and visibility that I get by virtue of a successful listing. It was quite interesting to see, how some of these promoters thought about. It was not necessarily a funding event. It was not necessarily, creating liquidity for any stakeholder. It was more about profile, branding, visibility that you get by virtue of a successful listing. So something which has kind of stuck with me. And typically, when we are dealing with consumer companies, consumer-facing companies, that is something we end up debating often. Look, as I understand, the target here is startups, and most of you probably have had some rounds of private equity VC funding done already. The reality is the day you take external capital, in most cases, it is not about whether to IPO. It is about when to IPO. The die is pretty much cast the moment you take external capital, because you're obligated to provide an exit to the stakeholders, or to the funds who you're taking capital from. Now, when to IPO, to my mind, is essentially a function of where you are in your life cycle. As a thumb rule, we typically advise companies to evaluate listing once there is a path to profitability within a defined time frame. And when I say defined, while there is no hard science to it, I would say ideally within the next 4 to 6 quarters. look, public markets generally don't like lumpiness in earnings. Now, if yours is a case where you are talking of expanding losses because of some of the events that you're taking, public markets, quarterly earnings, pressure, analyst commentary, etc. So, as a thumb rule, if yours is a case because of business reasons, if your losses are going to expand for the next 4-5 quarters, generally advice would be hold off. Let the loss trajectory start coming down. Let there be a visibility of profitability within the next 4, 5, 6 quarters. That may be a more appropriate time to generally think of listing. Having said that, there's no such thing as one size fits all. It's very contextual, and depending on specifics, one can always refine and fine tune the timing. Now, this was more in terms of broader listing and what ought to be the timing. But I think more importantly, the process of IPO preparedness. It's a fairly involved and fairly extensive process, and very often companies do feel overwhelmed with the quantum of work that is required to be done in the time frame in which you are. Generally when you press the pedal to go public, and the kind of work that kind of comes along with, companies very often feel overwhelmed. But I think realistically speaking, while the IPO process from point to point is about 6 to 9 months, I think if one is able to sort the preparatory work, prior to that, life becomes a lot more easier, when you actually start the work. Now, while of course Alok is an extreme example, he started work on it 3 years before he went public. Generally speaking, our advice to corporates is, around 4 quarters, around a year prior to when you actually want to go public, which basically means 6 months preparatory process, another 3 quarters, so about 18 months before you actually list, could be a good time to set the ball rolling insofar as IPOs are concerned. I think most important is to ensure that the internal reorganization and managerial bandwidth is in place. Generally speaking, we advise corporates to have 4 distinct teams. One focus on the business, which could be a combination of promoter, CEO, who kind of focus on the key positioning themes of the business, uniqueness, strengths, weaknesses, etc. The finance team, which actually ends up doing a lot of heavy lifting, comprising the CFO and key members of the account team. There are, generally their role is to look at, financials which are relevant for the purposes of inclusion in the offer document, and importantly prepare business plan for the next 3 years, which kind of, from which it also, your fund requirement also gets derived in terms of how much money you want to raise through the IPO. Secretarial team, comprising the compliance officer, which kind of, makes sure that all the regulatory filings are in place, all the housekeeping is done. Typically, you do a secretarial audit to see if there are any gaps and so on and so forth. And legal team, comprising of the legal head to make sure, all the litigations, etc., are properly maintained. An IPO DRHP is nothing like but loosely speaking Janampatri, right? So you have to make sure anything and everything right from inception of the company is brought out in a coherent manner, in the document. It's a liability document. So, tomorrow you don't want anyone to be able to say that XYZ information was missing, which could have affected my investment decision in a certain manner. So I think maybe, I will pause for now. And, I think I have taken enough of your time. Maybe, Alok, if you want to chip in, or, leave it to Samar to be able to take
We'll
forward.
go to Samarth now and just understand his perspective of what does it think about the time for IPO and any pre-IPO preparation that the company needs to be ready with.
Yeah, thanks, Alok. I think Nipun has covered a whole gamut right from scratch to getting to an IPO. I think the one thing that I do want to highlight, since we have a diverse audience, is, and that is what Nipun's underlying thematic was, IPO is not the end all. So I think too often we give far too much importance that, IPO as an event, we need to be scared, we need to start preparing. I think you should think of IPO as a step in the journey to a company that you have incorporated, you have founded, and organizationally, as you scale up, there are processes that you put in place, right? You put in place a more robust internal control process, you put a more robust finance team, a legal and secretarial team, besides the business teams that you have. In that journey, as you progress, if you put controls in place, if you start measuring or mapping your performance, start having a budgeting exercise where you track what you budget, how you actually perform against that, identify how you are judging your business colleagues in terms of their performance. If that prep is done well, i.e. you have a system of running a company day to day, system of running a company annually, system of running a company long term, you have all the basic blocks in place for any capital market event to happen, whether be it an IPO, be it a pre-IPO financing, be it a debt raising, because you have gotten your organization ready to handle internal data in a synthesized manner. What often we see as a challenge is that organizations are so focused on business that the process and the controls aspect sometimes are only put in place when the thought of a capital raising comes. Oh, you have to raise debt. Oh, banker was asking for some numbers and model and accounts. Why don't we now go and prepare them and we will get them across? Why I'm raising private equity, I have appointed someone or I'm doing it on my own. I'm putting 5 slides together on my business and I need to put together what my numbers were and what were my MIS data, and I'm just doing it. I think systems and process which you implement as you scale up, I think help you prepare for an IPO or any event that you want to do. And kind of that is what, in some sense, Alok and team had done. So, and going back to even 2016 or earlier, they always had a track of their own MIS. What are the key performance indicators they judge their business by? Because both Alok and Yashish used to run the business in a structured manner, because they said, while we two are co-founders, there is a team working. How do we track, we run, what is measured, what are people delivering, and their control on ensuring the organization is working towards a long-term and an annual objective ensured that when the time came for them to take the call, their accounts were ready, their KPIs were ready, their MISs were ready, they understood what they wanted to talk about their business, and that ensured that our prep was faster than it would have been in most other cases. In most other cases, people, when they think of an IPO, and which is why I think what Nipun is highlighting 18 months, because people start preparing all of these only when they think of an IPO. Oh, I will go IPO next year. So now audit, should I start doing monthly closes? Let's go and check the RBI, FCGPR forms, filing on time, ROC records done properly, correspondence, whether we have the right system in place. Oh, I need to get SAP because my auditor is now saying, okay, for closes, I need some systems. So all that process typically starts happening when you think of an event. If you stop thinking of the event, but if you think of your company that you have founded, that you have nurtured, as it grows, a company is made by you and the team below you. If you want to judge the company, how are you tracking it? Do you have a system in place? Do you have a control in place? If you have that in place, then you're ready for an IPO. Because all an IPO is requirement to coordinate, collate all of that in one place, put it in a disclosure document, take it to the market, and have the market reward you for all the good things that you've achieved.
Perfect. No, this is wonderful. Thank you very much, panelists. So to summarize, guys, you're talking about putting a governance structure. We're talking about getting the capital structure in place. If you have to do any bonus, any split, be ready for it. If you have to do CCPS conversion, be ready for it. You have to look at the way you are looking at your own data and whether the data has the backups. You have to look at the team in place, whether the team can take on the extra load which comes with the whole work of IPO. So very, very valid inputs, and thank you very much. I'll encourage the audience to put their Q&A if they have any as we go through this discussion. Now I'll move to something specific. You know, a lot of times there is an understanding about listing in India versus listing overseas. And then there was a lot of noise around the SPACs last year as well. So I request Samar to just give his views around how should a company think about all the options available to them and then pick the best option for their own journey.
Sure, Alok. Am I audible?
Yes.
Yeah, thanks for that. So I think with the liberalization of Indian capital markets, deepening of the domestic asset management industry, and contemporary products and disclosure regulation from SEBI, I think the gamut of product solutions that are available to a company, be it a startup or any old economy, new economy, however you want to classify it in its journey, is very broad, and it straddles from equity options to debt options. IPO, as I said, is one of the products. And if you look at from the vantage point of only an IPO, the options for an Indian business primarily include right now a listing in India, right?
Yeah.
If you are one of those companies which are incorporated outside India, yes, you have an option of an international listing. Or in some cases, as Alok said, you have an option of a SPAC. If you were to kind of whittle down to the key basic 4 criteria which help you decide how you should think it through, and this is a kind of discussion that all the panelists that you see here have had with companies over the last 10 plus years. A whole host of companies have had that discussion. Even Alok went through that discussion. I think it boils down to simple 4 criteria, right? For the founders and the management team, one of the criteria is value. which is value at IPO, value through the journey. How will I get benchmarked? Will I get the right comps, which may be global, may not be local? Will I get the right framework? Will people look at the right valuation metrics? And I'll cover these points and then I'll come to some of the market specific nuances. Second is disclosure and execution. What are the disclosure regimes? What is the process? How much the time takes? Whether there are any challenges, any things to be kept in mind? What are things to focus on with respect to the entire process as we go along? Third is financing flexibility, not only about doing an IPO, doing a follow-on, raising other products, whether a listing supports it, impedes it. I think that forms part of a decision-making criteria. And the last, which is the most critical and the most singularly important item, is strategic flexibility, which could be about acquiring companies. It could be about being part of a consolidation by someone. It could be about any of the strategic related prerogatives that we have, which drive people to do anything, fundraising to opening a new line of business. And these are the four criteria as you look at. And if you look at all of these four criteria very carefully, last year, effectively, we have established that India is able to deliver in all of these four criteria in the market. We have a regulator which has enabled us to list all types of companies, old age, new age, and recognizes and understands very well that the new age companies require certain flexibility and they're willing to provide it. So we have managed to do an IPO process, which is simple, yet a principle-based regime where disclosures are outlined. We can have a discussion with the regulator. Regulator is very happy to have a discussion, which is the regime which is there internationally. So from that standpoint, India is a very competent market and a very deep market. From a value perspective, in terms of pockets of investors, you can get the foreign capital, you can get domestic capital, which is very, very deep and has been one of the big supporters of the market in the last 5-6 months, as all of you would have seen the data. And that is only going to grow strength from strength as we see financialization of savings amongst all the Indians out there who are putting more money into the equity markets. Then if I look at from a financing flexibility, from a products perspective, we have all the equity products that are there. From a financing flexibility, yes, you can say from a debt flexibility perspective, India, given we don't have capital account convertibility, the Reserve Bank of India has certain constraints on how debt, which is raised offshore, can be used, purposes, what banks can provide debt for. But would say that the regime is liberalizing. Over the last 5 years, we have seen far more ability for Indian companies to raise onshore, offshore debt, structured debt, various other instruments. So would say that also from an India standpoint is now equally comparable. And from a strategic flexibility perspective, I think this point is a very individual company, board, shareholder management decision. We have seen most companies feel that the India brand equity that they create by a listing is superior to be able to list abroad. Not to say that you won't create brand equity by listing abroad. So right now, if we think of the four criteria, India listing is comparable, in some cases superior. Could companies which are incorporated outside India list outside India and achieve same objectives? 100% yes. But it will boil down to what they are doing a listing for. Is a listing just an end goal, provide an exit? I don't think any company thinks of it that way. Each company has a strategic objective that they think of, okay, with a listing, my growth will get channelized even further because listing means my stock is a liquid currency. Talent is a very big thing, both for old and new companies. ESOPs are a very big thing. And having liquid ESOPs matters a lot. So in that regard, both an international listing or an India listing would provide you that. So I would say right now, as things stand, an India listing, we have dispelled a lot of myths of last year, which before last year, if you had asked anyone, can India be as good a market? We would have all said yes, but you would say, okay, give me a precedent. Now we can give you several precedents to demonstrate the fact that India is as good a market to do this. If you wanted to do international, wanted to do other options, they are available subject to your structure, if it is possible. But from that perspective, I think what we want to establish here very firmly is India is the default option for every company that we speak to in terms of listing. And now most companies are thinking, okay, India is default. Should I think about others if I can go to the other options, which is an international listing if my structure allows it? And that's the discussion which has moved away from almost every company saying, okay, India versus international, even if structurally it was only India, but people wanted to debate that. Now fewer people are actually debating that. Sorry for the long monologue. Maybe I'll pause there to
Perfect.
pass the baton
Perfect.
on to Alok and Prashant if they want to add anything there.
Yeah,
Alok
I mean,
from
I think
personal experience and Prashant
the
there.
only thing to
Sorry.
add to what Samarth is saying is I think we're now seeing what I call internalization as opposed to externalization. We spent many years trying to create overseas holding company structures so people could list in the US or elsewhere. And now companies that have had structures already in place are collapsing that so that they can do India IPOs. So it's gone the other way, which is as I somewhat said, a good sign, and it's possible to do. We actually just completed one for one internet company which had an overseas holding company through a scheme of arrangement. Obviously, yeah, it needs to be thought through and it takes a little bit of time, but it is definitely possible, and we're seeing more of that actually.
No, very, very valid points. You know, one of the ways to also think about this, if you are an India-based company, if you have market in India and customer sites in India, you already have a brand recall, and IPO will just add to it. So, India should be, as Samar said, default option, and it gives you all the flexibility that any company will need. Other options sound very nice, but practically, when we also evaluated, some of them are more in theory, but practically not even possible given the regulations. And eventually, if you have the investor support, you have the research support, there is no reason for an India-based company in India market company to think of other options. So thank you very much for this. Now moving to a little different discussion here. You know, we started off with talking about pre-IPO preparation, but the whole IPO process itself is, as we discussed, 6 months, 9 months process. It's got its own nuances. Uh, there are multiple things to be done. So I request Nipun to just maybe give a brief overview of how the process and timelines look like once you start the preparation.
No, no, fair enough. Thanks, Alok. And as I mentioned earlier, while the process can seem a little daunting, but to be honest, if you have done the preparedness work, well in advance, the journey, the end goal turns out to be fairly interesting. So just if I were to, kind of, split it into, key activities, the first, I would say 8 to 12 weeks is a lot of heavy lifting, which is basically the time required to prepare what is known as DRHP, draft red herring prospectus. The document gets filed with SEBI. Now, importantly, what are the lead time items, in preparing the document? The first and foremost is accounts. Your accounts need to be as per Ind AS for the past 3 financial years, which are going into. In an offer document, you're required to disclose financials for the past 3 financial years, and those accounts need to be as per Ind AS. A number of you may not have transitioned to Ind AS right now, so that is something to be mindful of. If you're thinking about an IPO in the next 12-18 months, that is an activity you should set the ball rolling. Importantly, accounts need to be audited by a peer-reviewed auditor. Now, in most cases, given that some of you might have already had multiple rounds of investments, I suspect that is an issue that would have already been tackled. But those of you who may not have a auditor who is peer reviewed, that's a question best asked to the auditor. Whether they have a peer reviewed certificate. It's a certificate issued by the institute. But if not, that is something one needs to basically have it fixed. When I say have it fixed, it basically means either your auditor being able to get peer reviewed, or you need to have your accounts audited by a peer reviewed auditor. You need to change the auditor and get a new auditor. Second thing is SEBI guidelines on corporate governance. Any company which is desirous of going public, you need, at the stage of DRHP filing, you need to comply with corporate governance guidelines. Now, what does that mean? If your chairman is executive, which is often the case in a number of these businesses, half the board needs to be independent. And mind you, investor nominees are not independent. So you need to start thinking about the board construct. Uh, you also need to have one woman director on board. So those are things to be mindful of. Given the increased scrutiny, fiduciary responsibility, identifying the right set of independent directors who can add value from a business standpoint, it could be slightly lead time item, and I would encourage most of you to start thinking about. Look, let's think about it. When we are marketing a story to investors, what do they look at? One is corporate governance. Now, what are the proxies for corporate governance? Quality of investors that you have on board. If it's a auditor, which top 10 auditors which they can identify with. Thirdly, and very importantly, the names of independent directors who are on board. If these are names that public market investors can identify with, it acts as a big comforting factor, so to say. So something to keep in mind, as you go forward. If your chairman is independent, then you can live with one third of independent directors. So these are some of the things that you need to be mindful of. Of course, fleshing out your business well in the offer document, that is the most important aspect. End of the day, please understand your DRHP cannot have any forward looking statement. Your offering is sold on the basis of how the business has been brought out in the DRHP, which also find its way into the analyst research report. So fleshing out the strengths, strategy, positioning of the company well, again, an extremely important aspect which ends up taking disproportionate time in the run up to DRHP filing. So those are some of the things that you need to be mindful of. Of course, from a process standpoint, what you need to do is identify a lead banker. Look, as I said, some of these things could seem to be overwhelming, but if you have identified your lead banker, it's the job of the lead banker to ensure that he handholds you through the entire process. And I would say, the role is similar to an orchestra conductor in terms of managing the entire show along with lawyers, auditors, regulators, investors, leading all the way up to listing. From a process viewpoint, as I mentioned, about 8 to 12 weeks to file DRHP with SEBI. SEBI takes about anywhere in the range of 8 to 12 weeks, depending on the complexity, the level, quality of disclosure that you have brought out. So it takes about 8 to 12 weeks to give its observations. Once you get the SEBI observations, that approval, that SEBI observation is valid for a period of 1 year, i.e., you can launch a deal anytime within 12 months of date of receipt of SEBI observation. But generally, as bankers, our endeavor is as soon as you get SEBI approval, try and launch the deal within the next 4 to 6 weeks. Of course, subject to market conditions. So, if one were to think of it in an ideal world, the timeline that we're talking of is somewhere in the range of, call it, say, 25 to 30 weeks from the day you have actually kicked off the IPO process, leading all the way up to listing. Some of these timelines, as I mentioned earlier, could be subject to depending on how the market I would say mood, momentum, volatility is around the time you get the SEBI approval, and those timelines could be fine tuned accordingly. Typically, in an IPO construct, you can have a primary portion, as we call it, where money goes into the company, and there's a secondary portion which is OFS, offer for sale, where existing investors, including founders and employees, are in a position to sell. As a thumb rule, SEBI does not generally like companies raising blind pool. So when you are raising fresh proceeds, primary money into the company, you have to be able to justify in terms of why you are raising the capital that you are raising. SEBI, of course, gives you some flexibility. About 35% of the fresh money that you are raising can be earmarked towards general corporate purposes and M&A. But anything over and above that, you need to have a clear business plan and be able to satisfy the regulators in terms of how those monies are going to be used. While of course the IPO is probably slightly drawn out process, the beauty is once you are listed, thereafter the future financing is that much more flexible. Once you are a listed entity, if you need to raise capital for the next for some future growth plans, M&A, etc., there are very convenient processes, what is known as QIP, qualified institutional placement, or preferential allotment, which can be done much quicker and can be quite handy. As a thumb rule, our advice also to clients when they're going public is investors don't like companies coming into the market repeatedly. So when you're going IPO, try and assess what your fund requirements are for the next 24 to 30 months. Gross it up and raise it in one go rather than coming to market every year. Unless, of course, you end up doing a large acquisition which was unforeseen, which requires you to raise capital, that is fine. But the idea should be not to be seen in the market every 12 months, trying to raise some capital, doing some blocks to raise some liquidity, and so on and so forth. Final point I would like to submit is we all discuss about leading all the way up to the IPO. The important is IPO valuations. And to my mind, the biggest value add of banker is not about getting an IPO done. At least I, as banker, I feel the biggest value add where we can, where we probably end up, having the maximum amount of focus is ensuring we price the IPO well. When you talk of an IPO, it is not about achieving the highest valuations. What you have to ensure is get the best spread of investors. As both Samarth and I alluded to earlier, life just begins at IPO. Once you are a listed entity, the stock becomes your currency for all your future financings, for block sales, and so on and so forth. So the focus in an IPO should be to get the best spread of investors rather than just maximizing valuations. The idea is generally if you get high quality investors at the time of IPO, even if it's at a slightly lower valuation than what you initially hoped for, trust you me, it gets compensated for post listing, provided of course you continue to deliver, on the performance and are able to manage investor expectations well. So yeah, I think these are some of the thoughts, but yeah, happy to address any specific questions that the team might have.
Oh, great. Thank you very much, Nipun. So as Nipun mentioned, it's a process, but you have got your advisors, banks, councils, uh, for that matter, even your auditors and ICA and a lot of other people who are there as part of the journey. And the timeline that you can keep in mind once you've done your pre-IPO preparation, it's somewhere between 6 to 9 months. Uh, it's a considerable effort, and there are a lot of key considerations as you're going through the whole process. And if you look at the regulatory aspect of it from SEBI perspective, that's also been evolving. So maybe we can now move on to Prashant to just focus on some of these things. How does you look at some new stuff that SEBI is coming up with, and what are the key considerations apart from the ones that's mentioned by Nipun and Samarth as a company is looking at IPO?
Yeah, thanks, Alok. A lot has happened there in the last 1 year, and I think you have been very lucky to have listed at just the right time. The kind of pain that we're going through right now is at a different level. I think some of it is being brought on by how the markets have performed in the last 3-4 months. So the regulator obviously is probably being a little extra precautious on that front. But I think 2 points that Nipun had mentioned, which I just want to add on before I go there. I think one is financial statements and financials preparation. Alok knows this better than anyone as the CFO, is don't change your auditor or your audit partner kind of in the middle of an IPO process. It is not a good idea. So if you think that your auditor is up for change, please let him do an audit, get used to your financials, how your finance team functions, because no matter who your auditor is, when the IPO comes up, the level of scrutiny that they will put the company through is at a very different level. I think that was one thing, and I think Nipun had mentioned corporate governance. So not to spend more time there, but I think what has happened is that it is becoming more difficult to find the right independent directors. Everyone, obviously, the management team, the shareholders will want to be comfortable with independent directors, and to find 50% independent board and on a get-go is getting more and more challenging. So I think a lot of companies, I would recommend start bringing on at least 1 or 2 independent directors 12 months ahead of an IPO. It actually, hugely benefits management. They get more used to the company. To bring on new independent directors, just the level of governance and comfort is much higher, and you'll see the process going much smoother. I think in terms of sort of one other issue that I wanted to talk about was acquisitions. Obviously, everyone looks at acquisitions as a growth perspective, and we've seen a lot of companies doing large acquisitions close to IPO. To be honest, it is a lawyer's nightmare. Large acquisitions in the middle of an IPO process. It also adds hugely to the complexity of disclosures, what you have to do, you pro forma financial statements of the target, information from the target. So if there is a large acquisition that you think you want to do, I think it's better to do it. I think in the 8 months that we were doing the Policy Bazaar IPO, Alok may have asked me 3 times, should we do this? And I have told him no every time, which he may hate me now. But I think at least his IPO got done pretty quickly. I think there are other companies who did material acquisitions, and honestly, their IPOs are not got done. So because it does add 2, 3, 4, 5 months to their IPO process. So just keep that in mind. I think 2, 3 other recent changes that have happened, and almost in 2022. I think one is SEBI has started to look at disclosures in relation to how these high growth or new age companies, as they call them, are being benchmarked to peers on pricing. One of the things that they have come up with more recently is disclosures on KPIs. Now, KPIs being key performance metrics or operating metrics like GMV, for instance. Historically, obviously, SEBI has been used to more traditional pricing like debt equity, but etc. Now, those obviously don't work in some of these sectors, which I think has come to their knowledge post the first 4 or 5 deals. Now, they are putting a huge amount of scrutiny and disclosure obligation on the company. and the banks, obviously, and the lawyers on what kind of KPIs are not only disclosed in the offer document, which is the prospectus, but what they have disclosed to investors. At this point, their ask is 3 years prior to the IPO. That is a humongous task, not just for management, but for lawyers and bankers to be able to diligence, because we don't know what information you may have actually provided to people, right? I mean, you may have been providing information which at that time you thought was fine to provide, etc. Now they want all of that information to be put in and for us to explain if that is relevant or not. And that's fine. It's just that trying to get to the bottom of that information in some cases has taken us a huge amount of time, because honestly, the company had not even kept some of that information. So track down emails, Excel spreadsheets that the company had given. And while I think we have given, between the bankers, lawyers, others, a lot of feedback to SEBI on their consultation paper, they have already started giving this in observations. And that is not an ask we see them changing, because I think they feel that a lot of these discussions happen with perhaps institutional investors, but retail investors are not sort of in the know of, why this is important, etc. And they want all of this information to be disclosed. It is time consuming. The only sort of point I'm trying to make is when you are providing such information to possible investors in a private rounds close to the IPO, one, keep track of it. Don't provide information that is not necessary. I think sometimes people feel like, let me just sort of give the full dump and then people can decide. I think that is no longer a good idea. I think give as much information that is necessary or has been asked for, or you think is relevant from what peers are providing. Nipun had briefly mentioned on use of proceeds and how that can be used. I think that has again become a huge focus area. That was one of the things that SEBI had, in the earlier sort of deals like Zomato, Paytm, Policy Bazaar, been fairly accommodating on the requests on how the money can be used, and sort of moved away from their more traditional CapEx, kind of disclosure for companies. They have sort of become stricter on that in the last few months, because I think they felt that investors need more information on how the money will be used, particularly retail investors. So that's sort of an evolving framework. Now, this may change completely again in 12 to 18 months, so it's really unclear. But one thing that they realize that they don't like is, as Nipun had mentioned, blind pool acquisition, which is just to say, I want to raise $1 billion in acquired companies. They are not okay with that. They want to be told which companies you will acquire, and obviously you won't know that. So spending some time on how you will use the IPO proceeds, that also has to fit into the model that you will present to the banks and the investors will build. So all of that is sort of a discussion that goes along. One other interesting area, which is very recent and it's come out in the last week, is the SEC in the US has increased disclosures on cybersecurity related issues. Now, the only reason it's relevant for India is we follow US disclosure norms because we market to US investors, even Indian IPOs. And some of the asks from the SEC are actually fairly detailed. Some of the companies we've done, they've actually done IT audits sort of close 1 or 2 years before the IPO, which has been very helpful. I strongly recommend any company sort of at least in the internet or tech space to do one, actually tells them what is wrong or what were the issues in the IT system. Also, just from an internal controls perspective, for a listed company, it does give huge amount of comfort to independent directors as well once that has been done. And as part of the IPO process, now banks or lawyers will ask for it, and it is not something that you can sort of do in 2 or 3 weeks. It is sort of a longer term project, so better to do that at least 6 to 8 months prior to the IPO. So the sort of the bigger picture, recent changes and things that are along here. Samarth, anything that you have, please add.
Yeah, so I think Prashant, you've covered all the points. The only thing I would say is all of the things that you hear all of us say may make it seem like, oh, it's too complex. But the only point I want to say is if you are prepared for basically a system and process culture in your organization much before you actually have to do an event, I think these things become par for the course. There is nothing special about this, right? If you do your annual audits on time, if you think about your key business metrics each time you are running your business, right? As a founder, you are running your business. You know what is it that matters in your business, what you track. If you know what you track, then it's very easy for you to tell any investor, whether in a private fundraise or in an IPO fundraise, this is how I measure my business. This is how you should judge the business to be. I think the key additional element that I have to say is we are seeing greater integration of business and finance. Now, as we go to IPOs, what do I mean by that is the way you tell the story has to be apparent from the numbers. Very often what we find is the challenge is that we want to create a narrative, but the numbers necessarily are not able to go towards that, and we have to, in a lot of companies, discuss whether we are doing revenue breakups a particular way, if we are discussing segment approaches a particular way, in order to ensure that the financial data helps people understand the business better, and people can marry the two and make an investment decision. And I think that is one area where, as you prepare, a greater amount of focus will go. While that has been an area of focus in terms of discussion, but I think now over time, we will see greater amount of discussion and discourse on the fact that uh, the integration between business and finance, and trying to have your financials represented in a way which makes it easier for you to explain the business, and people can read the two without having to put any additional explanation, is the right way to go.
No, perfect. No, this is very, very helpful, Samath and Prashant. You know, the life as a listed entity is definitely little different, but I totally agree. The process is more procedural, and you've got all help available through your banks and councils to handle you through the journey. The basics have to be in place, and for that, if you have an early chat with your potential partners, that would always help. At least some of these things that MIS obviously everything that we live by, but MIS has to talk to the financials, and uh, eventually it is the financials which have to be published, uh, and you have to be able to disclose your decision making based on those financials. Somewhere that linkage has to be very clearly established. One of the things I always tell everyone that if you are looking at IPO, you should look at some sort of predictability of your numbers. No one wants that suddenly the numbers have moved in a very major way in either direction. So if you, as a management team or as the business matures, you know that you have a business which is heading in a particular direction, and yes, there will be surprises. No one says that there won't be surprises, but at least at a high level, you as a management team and founders are able to predict what's going to happen. That is always very, very helpful. I'll maybe take a few minutes to explain our view in terms of how our life has changed. It's been little over 4 months for us since we listed. We have gone to the first quarter reporting, investor calls, and all. So I'll maybe just explain what we are experiencing right now. But meanwhile, while I do that, I'll encourage audience to put up any questions if they have uh, on the panel, so that we can handle your queries. You won't get this sort of august gathering in one place very easily. So one of the foremost things is that you have much higher level of public and media scrutiny. Now, as a private company, you may choose not to have it that much, but as a public company, you don't really have a choice. You have to explain each and every decision and the rationale behind that decision, because every decision or even a rumor can impact your stock price, and that stock price movement actually a lot of times does not even impact investors who are looking for long term, but retail investors get impacted, your employees get impacted. So somewhere you have to have a very clear rationale for everything that you are doing. You have to interact a lot more with analysts and investors, because you get covered by few analysts, and once you want that coverage, they obviously have to understand a lot more about your business. They will do their own modeling. uh, as a private company, see, you talk to few investors whenever you want to, and those are private conversations. And as Prashant was mentioning earlier, you can have a lot of discussions about future, about your vision, all sort of stuff when you're talking to a private investor. And the reality is, you may talk to 10, you may talk to 50, or you may talk to 100, but eventually you want one or two or three to invest. But as a public company, you talk to a much larger set of investors, and you have to get everyone's alignment. Plus, your flexibility in terms of forward-looking statements obviously gets cut down. Uh, as a company, you have to be very clear what is the stance you want to take in terms of your investor interaction once you're listed. You also have to take a stance in terms of forward-looking statements, your focus on short-term versus long-term. All those things you can't keep on changing on a quarterly basis or a yearly basis. So those have to be decided by the management as you start your journey as a listed entity. From employee perspective, there is definitely an impact of price going up and down. They do get liquidity, benefit of listing, but there is a very, very important consideration from the insider trading perspective that company and the employee need to be aware of. See, since you're listed, you're taken the public money. So if your employees have some inside information then there will be a very, very guideline in terms of when can they transact and what is the process of transacting. And there are specifics about what they cannot do. So as you start your journey as a listed entity, those are some things which become very, very important. We did discuss about board and governance and committees and SEBI compliances. So that is something which has to be taken care of. And it's a learning curve. Every day you are learning something new. The focus on some of these things is at a very different level once you are listed. My only advice once a company thinks of listing would be, don't look at the stock price on a daily basis. It doesn't help. There are too many factors which are not in your control, something happening in some other part of the world, something happening in some other company. Everything can have an impact on your stock as well. So you do what you can control, which is focus on your business and communicate your story in your own words to the wider audience. So that's something which I like to share. Now we still have about 15-20 minutes. If there are questions, please type in the Q&A panel. Otherwise, I'd like to just move to one very important thing which Prashant had mentioned and we touched upon a little bit, which is the capital structure. How does a company plan for capital structure if they're not very, very sure that they will do IPO, but potentially they may do in next 1 year, 2 years, or 3 years?
Samarth, you want to take that? Alok, you want who should?
Yeah, I just wanted to. Yeah, just wanted to add one point on the post IPO journey. Think of the post IPO event as dealing with a crowd. When you are private, you were dealing with friends because you decided who came to your room, who you met, who you could pick up the phone off. When you are listed, you are dealing with a crowd. Crowd is only best dealt with crowd control processes. So declaration of results, as Alok said, talking to people, communicating your story, and beating expectations rather than just meeting. I think we live in a market where being conservative and beating investor expectations is very good because that creates that track record. There are veterans in the industry, like if you think of an Infosys example, consistently beating has created a cult following for that stock and has ensured that people are very well invested over a long-term period there. And there are several such companies like that, right? So I think if you think of a post-IPO journey, as Alok said, focus on basics. Don't watch the stock market daily. Don't need to go to CNBC every second minute and see what is happening in the world. I think focusing on business. But when you are doing kind of a listed, kind of managing a company, you are dealing with a crowd. So you have to do the processes for crowd control, which involve being available, speaking, talking, communicating the story, and focusing on business. That is what happens. Coming to the cap structure topic, I think from a legal perspective, I'll let Prashant chime in, but when you think of a cap structure of a company, the greatest amount of flexibility comes in having, I would say, if you're looking at equity side, compulsorily convertible instruments, which are not shares in the current journey, which provides you as a flexibility later from a bonus split perspective, when you really want to do from that part of the cap structure, which is legalese cap structure. If I want to do a cap structure from a corporate finance perspective, which is equity, debt in my cap structure, and what's the right mix, I would say that journey for Indian companies is evolving, and we are seeing gradually debt become relevant. And over time, we do think that more and more companies, because equity comes with a dilution, in India will have options beyond equity in the form of either hybrids, mezzanine, or pure debt, which they will be able to tap in their growth journey and avoid a dilution, which a lot of companies have had to do over the last decade. So kind of the two perspectives, one legal, which I'll let Prashant dive in, and the other from a CorpFin perspective, thinking about cap structure. Prashant?
Sure. I think from a legal perspective, I mean, I think I mentioned one, which was how to keep founders incentivized. I think the best way is to do ESOPs, which means just making sure they are not promoted in your annual returns, which is easy. And honestly, some people don't think about it, but you don't need to get a very high paying lawyer for that advice. I think the more sort of important aspect that ends up being is that a lot of companies that are high growth end up, by the time they come to IPO, with share prices of 2-3 lakh rupees, which is not obviously something that you can go to IPO with, from an IPO perspective. In the olden days, people used to say 100 rupees. Now I think it's become 1,000 rupees. But I think 1 lakh still is obviously not going to work for various legal reasons as well as marketing reasons. So I think to get to this, even a sweet spot of 1,000 or 500 rupees, you end up doing, I think believe we did a 500:1 bonus, if I remember correctly. Now, what that means if you end up doing a bonus is that it has adverse tax consequences because bonus shares are treated as new shares for shareholders. So if they're going to sell those shares in an IPO, they will be taxed in short-term capital gains. So actually doing a bonus earlier is very good. So look at your cap structure. I think the point I'm trying to make is look at the cap structure earlier, the share price. If you can do this 1-2 years prior to IPO, it will save a lot of tax for a lot of people, including founders and shareholders. I think ESOP, not just for founders, but also for employees. I think it's a good thing to know what you want to do at the time of IPO. What is the size of the ESOP pool going to be? One of the more recent sort of focus areas for public shareholders, proxy advisory firms, is the exercise price of ESOPs. Now, in the Western markets, particularly US, it's always been fair value. In India, I think the trend has always been do 10 rupees or whatever, 5 rupees. So that is basically free shares for the employees or the founders. Now that just means a very large charge. Well, there's two things from proxy advisory from public markets. They feel that does not incentivize founders and employees because they are already deeply in the money on those ESOPs, even at the time of IPO. And therefore, there is no incentive for them to keep growing the company at the rapid pace. And therefore, public shareholders who invest at a much higher price suffer. And two, which some companies are facing, the amount of ESOP charges goes on the P&L every quarter, while institutional shareholders know what that is and kind of know that is a non-cash charge. If you look at Indian newspapers, every time an earnings result comes out for one of these companies, it just shows the profit, the loss having increased 70%. No one actually focuses on business fundamentals in India or the media. And that just creates negative vibe. It becomes very difficult to it's like it's a churn that is very difficult to come out of because no one who is writing those articles in the media is actually reading or attending analyst calls that the management is doing to explain results. And that is very difficult to explain in India. So, it's not something that should sort of, follow you, but it is becoming a point of discussion. So when you're thinking of ESOPs, exercise price, etc., I think it is a point that you should keep in mind going forward. I think because that will become a point that public shareholders will keep bringing up over and over again. Nipun, sir, anything else you want?
No, I think points well covered. Just one, additive point would be, look, in a listed, we spoke about this per share price. So as bankers, our endeavor is always to keep a 3-digit price rather than a 4-digit, if it is possible. Purely from managing the optics for retail HNI. Now, in a listed universe, if you have held the share for a period of 1 year, that is considered long term. But in an unlisted universe, when you're selling shares through an IPO, what is considered long term, especially for shares being offered for sale, is a 2-year holding period. So to the extent any of the companies that we have in the audience, if your share price is running into multi thousands or lakhs, and if you have plans to evaluate an IPO in the next 18-24 months, I would suggest get the bonus done ASAP, so as to ensure you have enough old shares, i.e. shares which have been held for a period of 2 years, which will hopefully attract long-term capital gains, which is at a concessional rate, vis-a-vis a short-term capital gain if you plan to sell part of those shares in the IPO.
Perfect. But how does a company manage ESOPs or phantom ESOPs in case they have got something of that structure in place?
So phantom stocks, are fine. There's no regulation around phantom stocks, and people can keep them. I think that the issue with phantom stock really becomes cash payment, Alok, as you know. For phantom stocks, actually, there is a cash outlay by the company. So, very few companies really like that because obviously no one wants to, be cash down, which is understandable. But that is something that is doable, but very, very seldom do people actually utilize that aspect. I think partly paid, as I had mentioned, has become a very common way of sort of incentivizing people, but it has huge issues as you get closer to an IPO, which are not great. This is not a great forum to discuss them, but avoid partly paid shares if you can. Is my only advice. We actually have a question in the panel. I don't know if someone wants to take it.
So there's a question by Akansha saying, which is, what is the toughest part or critical stage of doing an IPO? From the retail investor perspective, what are the areas of listing should an investor look at other than the usual financials, etc.? So anyone can take that actually. So first one is, what is the toughest part or critical stage of doing an IPO?
Look, maybe your practical experience is better on answering that rather than us
Yeah.
giving an answer from an
us.
advisory
See,
perspective.
I'll divide the whole process into two, three parts, as I said earlier. The first one is where you are working on the DRHP. It is very procedural. You need 3 year financial statements. You need a lot of KPIs, backups. You need huge amount of discussion around risk factors, your research reports, a lot of stuff. But as I said, all procedural. If you have the right advisors, you can get through that. It may take a couple of week extra. That's all. Now the second part is the whole investor meetings and roadshow. There again, these are all pre-planned, and if as a company and as founding team you have been interacting with investors over years, this is something which is actually not very very tough. It just till last year, I think, because you were all working out virtually, it was very very quick. Otherwise, it required a little bit of effort in terms of travel. That's all. I think the bigger aspect of this whole thing is. How do you manage as a company in terms of bandwidth, not only for the teams which are directly involved, but also for the teams which are not directly involved? You know, your business heads, how much time do they need to spend on IPO process, and would it mean that their focus is taken away from the day-to-day business? Similarly, how do you look at the load which has to be shared by legal, finance, MI, secretary, all those teams? And it's very tough to hire new people at that stage who can suddenly ramp up. So, in terms of the whole process, I think first the time around the actual directory filing is where the load increases a lot, and there is little bit of little bit of uncertainty in the mind that it will happen today, tomorrow, next week, and you just want to get it done with because you have spent 3 months working on it, and you are almost like at the end of the fatigue cycle that just do it. But eventually there is a lot of unknown, and that unknown brings its own complexity. As a company, we always used to go back to our advisors because we didn't really understand how the SEBI part will work, or how the investor part will work, or how the valuation part will work. And I would encourage anyone who is thinking of IPO to start getting a core team in place of not only internal team but even advisors as early as possible, because that is very very helpful. Take advice from your board. A lot of your board members will have some experience in terms of how does the whole process work, and they can also get involved to some extent. In our case, we created an IPO committee where all the decisions were taken collectively for the company instead of going to the board every time, and those IPO committee members were available whenever you wanted. So that's the broad thing. In terms of what should a investor look at other than financials, one thing which gets overlooked usually, and this is something which I have found in a lot of my investor interactions, is team and culture. If you are putting your money in any company, you have to be very very comfortable that they have the right culture, they have the right team, and they have uh, the tenured people who have stuck around. That's something which gets overlooked a lot of times. We are talking about very tangible numbers, more of Excel modeling. uh, Risk factors are okay, but a lot of those risk factors have become very you know procedural thing again. I mean, out of say 70 80 risk factors, maybe two or three are the real risk factors, others are just there because they have to be there. But I think as an investor, I would definitely want to look at team and how the team has stayed together while they were building this. Anything you guys want to add, please?
Absolutely, and maybe if I could probably just extend it, team also, the natural derivative is the governance construct. Look, when an investor is investing in the company, the reality is he's not buying a bond. It's not a fixed return instrument. It's a business, and business will have ups and downs. It's extremely important that the team that you are backing communicates consistently, communicates well. If there's a bad news, communicates well in advance, so that you can, if let's think of it from an investor standpoint, right? If it is investing in a company X, if you were to exit that company at a 20% post listing, he has to deploy that capital, find another company where he can, earn that incremental 20% on the money that he's investing, right? Or on the capital that he's investing. So the idea is to be able to find what we call long-term winners, long-term compounders, where you invest in those managements, very well recognizing that it's a business which comes with its own set of risks. It will have up and down. But if it's a management which is, transparent, communicates well, consistent in delivery, hopefully over a 3, 5, 7 year period, your money will compound well. I think that is what I would like to submit.
Perfect.
Somewhat the last question, I think, if you want to take that.
Yeah, so
What
there's a
factors
question
to be
which is
considered?
talking about how does the vested shares which have not been exercised by an employee, how does the income tax liability work on such shares when a company goes for IPO, and the exercise will happen at the market price which is determined by the IPO. Uh,
That's a
you know,
tax question.
it's actually not a very complicated one in terms of answer. Uh, Once you have listed, you're right, the value is determined by the market, and that becomes your excise price. And your income tax will be on that excise price at the time of on the day of excise. Uh, so whether you are in 30% bucket or 20% bucket, whichever bucket you are in, you'll have to pay tax accordingly. There is no choice. When you excise while being private, there is usually a little bit of discount which is given by the merchant bankers, but it also links back to the last round of funding. So it's not that it's a major difference in terms of the approach, because typically when you are private, there's lack of marketability, and there are a lot of restrictions from the shareholder agreement which come on those shares, and that's why there is a discount. Once you're public, because you're getting liquidity, there is no more any discount, but you have to pay the full tax as per your income tax slab.
But maybe Alok, if unless I got the question wrong, at least my sense is if you have the income tax liability only comes in when you are exercising the shares. If your
Yes,
shares are
only
vested
excise.
but not exercised, there is no liability that accrues, to the holder, of those options. And typically, when
That
you
is true.
yeah, and I think the latter part of the question, when the company goes to IPO and is forced to exercise, there is no compulsion to exercise. When the company is going public, you can actually hold your options in the options format. The only period where we as merchant bankers dissuade employees from exercising options is between the time when we file the RHP and the issue
Hmm.
launch, and which is typically a 2 week process, because you don't want the capital structure of the company to change in that interim period. Otherwise, there's absolutely no compulsion. Even if a company is going public, an employee can continue to hold options in the vested form which is not exercised. Prashant, is that correct?
That's correct. Absolutely right. So
Yeah.
yeah,
Yeah.
obviously a lot of people who have vested shares do it pre-IPO because obviously once, as Alok mentioned, there is public market fair value price, so tax get indexed to that price. But yeah, there's no reason to. Nothing forces you from exercising ESOPs.
Yeah, and also, just for the audience, they will have to talk to their companies. Your ESOP scheme typically, once you're going through the IPO process, has to be SEBI compliant. So there will be some modification which required on the ESOP scheme, but as Nipon mentioned, there is no way company or anyone else can force you to exercise if you have the flexibility. So you can continue having those ESOP, but whenever you the market value of that day. So the way it works, usually the formula is very simple. If you're exercising on day X, the closing price of day X minus 1 is taken. Or if the day X is a non-trading day, then last day's price, opening and closing price average. On the exchange, you have the most volume. Sorry, I've got little more technical here, but yeah, it's fair market value which is determining it. Perfect. So I also wanted you guys to help give some guidance to the group, because we hear a lot of things like anchor and MF allocation and maybe insurance company
Alok,
allocation and FI allocation, retail, corporate, all that stuff.
we've
So
got two more questions, or if you want to answer them in
oh,
five
I,
5 minutes. One question is what factors to be considered whether to bring an IPO in India or abroad, or which is the easiest markets to list. Somewhat maybe that one is best answered by
yeah,
you.
let's go with the
Yeah,
questions
yeah,
then.
yeah.
First one, as you said, whether to bring IPO in India or abroad, what are the factors to be considered, and which is the easiest market to list? Samath?
Yeah, I think this is like a trick question. Nothing is ever easy in life. So I think as we discussed and as we went through with the panel and walked through it, India is the default option to list. Structurally, if you are incorporated abroad for your business, if for any reason you have done that, you have options to list both India and abroad. And then it boils down to your strategic decision where you want to list for the objectives that you want to achieve. I would say for a normal Indian business, India would be the default option that they would choose to list. And it's a much simpler thought process as we see in companies as compared to in the past when this used to take a lot more decision making, as Alok even outlined when he and Yashish and team went through that thought process. So that's how I would say that is. The next
Okay.
question is,
The next one is,
with
with
the
the unsuccessful IPO by few startups, how valid is it that startups show IPO plan in their pitch decks and future strategy? Uh, See, I'll let panel chime in as well, but if you are able to raise money that you went out to raise, the IPO is successful. Because IPO is a specific event through which you are trying to raise money from public markets. What happens afterwards is something which has a lot of factors which result into those price movements. Uh, I don't think any startup show IPO as part of the pitch deck when they talk to the investors. It is the investors who would want that as part of the shareholder agreement, that at some point you would want to look at IPO seriously in this time frame and this valuation. But Rarely I think I've seen any company talking about IPO as part of the pitch deck. Guys, anything you want to chip in? So perfect. So I think we've had a very interesting conversation. It became a bit technical for some people who would have heard some of these things for the first time. But as I look back on our own journey, uh, when we used to talk to Samad, Nipon, or Prashant, it was always like, oh, this sounds so complicated, and there's so many things to be taken care of. But as you go down the process, as you keep on talking about these multiple times, you get accustomed to a lot of these things. Today we talked about, say, SPAC, and you will say, oh, what is SPAC? And over time, you realize, no, it's nothing complicated. And you have got all the advice which you need in case there is something which is not intuitively easy to follow. Uh, so my only submission here would be, if you are serious that in next 2 years, 3 years, 4 years you want to do that, start educating yourself, start talking to people, understanding the process, start building your team, governance structure in place, capital structure in place. Some of these are possible to do in parallel. Some of these are one after another sequential activities, and some of these activities also have their own time frame. It's not that even if we wish, it can happen in 1 week or 2 weeks. Sometimes it takes 3 months, 2 months. So as you're building your business, anyway, it's very tough to get focused on some such stuff. But designate someone within your team who has this at high priority, who is focusing on this. Keep a track of exactly how this journey is progressing, and I don't think it's something which anyone needs to be afraid of. It's a in fact, one of the momentous event in the life of the founder, in the life of the company. This is what you have been working towards for last so many years, and getting the recognition from the public markets. It's the supreme validation that you can get. So with that, I'll thank my fellow panelists, Samad, Nipun, Prashant, for taking out the time and sharing your inputs with the group. Thank you very much.
Thank
Thanks,
you.
everyone.
thank you.